Gold. It's often seen as the ultimate safe haven investment, a shield against market chaos. But what if I told you that even seasoned investors make critical mistakes that could turn this is safe investment into a costly trap? In this video, we're diving deep into the 7 fatal mistakes most investors make with gold. To keep things real, I'll share quick stories about how each of these mistakes has caught investors off guard, costing them thousands, even millions. Whether you're new to gold or a long-time investor, these stories will show you exactly what to avoid. Plus, stick around to the end for a bonus tip. It could be the difference between protecting your wealth and watching it slip away. Meet Carlos. He'd heard all about gold's reputation as a safe investment during uncertain times, so he rushed to buy his first gold coins. Eager to get started, he didn't spend much time comparing prices. The dealer sold him on the idea of limited edition gold coins with promises of high value and future rarity. What Carlos didn't realize was that these coins came with a 20% premium over the spot price. Carlos walked away feeling confident, but here's the problem. He's already 20% in the red, and gold prices would need to jump just for him to break even. Worse yet, when he tried to sell the coins later, he found out that no one else was willing to pay those inflated premiums. Carlos's mistake was not unusual. Many first-time investors get caught up in the excitement and buy gold without understanding the difference between spot price and the premium they're paying. The spot price is the actual market value of gold, and anything above that is a premium, which can drastically impact your returns. First, know the spot price. Always check the current market price of gold before making any purchase. You can find this online in real time. It's crucial because paying far above this price sets you back immediately. And second, buy smart. Stick to reputable dealers who sell bullion or well-known coins like the American Gold Eagle or Canadian Maple Leaf. These coins typically come with lower premiums and are widely recognized in the market, making them easier to sell when needed. Carlos learned the hard way that the price you pay up front can either make or break your investment. Every dollar spent above the spot price is a dollar you'll have to wait longer to recover. The higher the premium, the harder it is to see real returns. Overpaying for gold is like starting a race from behind. The key is to buy as close to the spot price as possible. This ensures that your investment has the potential to grow from day one without unnecessary losses. James, feeling confident after purchasing $50,000 worth of gold bars, decides to store them in a home safe to save on costs. At first, it seemed like a smart move. Why pay for storage when you can keep it close, right? But then a break-in happened while James was on vacation. His gold was gone, and to his shock, his home insurance didn't cover the loss. This is where many gold investors go wrong. They underestimate the real cost of owning gold. It's not just about the price you pay up front, it's about where and how you store it. Whether at home, in a bank vault or a professional storage facility, ignoring storage and insurance can lead to massive unexpected losses. When you own physical gold, you have to think long-term. Gold bars and coins need to be safely stored and insured against theft or damage, and those costs can quickly add up. Bank deposit boxes, for example, can cost $50 to $200 a year, while third-party vaults charge a percentage based on the gold's value, often around 0.5% annually. James thought he was saving money by avoiding storage fees, but the loss of uninsured gold cost him far more than a few years' worth of fees. One. Choose secure storage. Home storage seems convenient but is often risky. Bank deposit boxes or professional vault services are much safer options. If you choose professional storage, make sure the facility is reputable and offers full insurance coverage. And 2, don't skimp on insurance. Home insurance rarely covers gold, so you'll need a separate policy if you're storing it yourself. Professional storage services typically include insurance, but always verify how much coverage you have, especially if the value of your gold increases. The cost of storage and insurance might seem small, but neglecting it could leave your investment vulnerable. For James, a little extra planning could have saved him from a devastating loss. It's not just about buying gold, it's about protecting it for the long run. Gold is a valuable asset, but don't forget the hidden costs that come with owning it. Secure, insured storage is an absolute must to ensure your gold remains an asset, not a liability. Imagine John, a new investor. The market was crashing and headlines were filled with fear, economic downturns, inflation, you name it. John, wanting to protect his wealth, went all in on gold. After all, everyone says gold is the ultimate safe haven, right? At first, John felt smart. Gold prices were soaring while everything else was falling apart. But then the economy started to recover, the stock market bounced back and real estate began booming. Meanwhile, John's gold, it just sat there, stable, but not growing. While others saw their investments in stocks and bonds rise, John was stuck, watching his portfolio stagnate. John made a classic mistake. He overinvested in gold, thinking it was a foolproof strategy. But here's the truth. Gold is fantastic during uncertainty, but no single asset should ever stand alone. Gold's role is protection, not long-term growth. A diversified portfolio is like a well-balanced meal. Sure, you need your greens, that's gold, but you also need protein, stocks, and carbs, bonds, to stay healthy and thrive. If you just eat spinach, you're missing out on nutrients that keep you strong in different situations. Number 1. Don't go all in. Limit gold to around 10 to 15% of your portfolio. This way, it provides protection during downturns, but you still have other assets that grow when the economy rebounds, like stocks, which historically perform well over the long term. And 2, plan for growth, not just safety. Diversifying means preparing for all scenarios like crashes and recoveries. When stocks rise, bonds stay steady and gold holds strong. You've got all your bases covered. Like John, many investors get too focused on safety and forget about growth. The problem with betting everything on gold is that you miss the upside when other investments start climbing. Diversification lets you benefit from both worlds, safety and growth, so you're not stuck waiting for another crisis to make a move. Don't be like John. Gold is essential, but it's not a one-size-fits-all solution. Diversify your portfolio to protect your wealth in bad times and take advantage of opportunities during the good times. That's how you build long-term financial security. Let's talk about Sophie. She had been watching the news, and headlines were screaming about inflation, economic instability, and the rising price of gold. Feeling the urgency, Sophie jumped in and bought gold right when it was skyrocketing in value. At first, she felt like a genius as prices continued to climb, but shortly after the market stabilized and gold prices began to drop. Sophie made a classic mistake. She bought gold during the hype, right when it was at its peak. Now, she was stuck waiting for prices to climb back up just to recover what she had spent. The truth is, many investors do this. They panic buy during crises. But by then, gold is often overvalued. When the economy settles, those high prices fall, leaving them in a tough spot. Gold prices tend to spike during times of crisis, when fear is high. People flock to safe assets like gold, but when you buy at the peak of that fear, you're paying inflated prices. Gold is a long-term investment, and the best time to buy is during periods of calm when prices are more stable. Sophie's mistake? She let fear and hype drive her decision instead of waiting for a better entry point. First, don't follow the crowd. When everyone is rushing to buy gold, that's often a sign that prices are inflated. Wait for calm periods when fewer people are paying attention to gold. That's when you'll find better opportunities to buy at a fair price. And second, think long-term. Gold isn't a get-rich-quick scheme, it's a way to protect your wealth over time. By buying strategically and holding for the long term, you'll benefit from its stability without overpaying during market panics. If Sophie had taken a step back and waited for prices to settle, she could have entered the gold market at a much lower price. Timing is everything, and gold investors often make the mistake of rushing in during market spikes, only to regret it later when prices correct. Don't let fear and hype dictate your gold purchases. Smart investors buy during calm, not chaos. The key to successful gold investing is timing. Buy when others aren't, and hold for the long term. Meet David. After hearing about gold's reputation as a stable investment, he found an online dealer offering rare gold coins at what seemed like a bargain. Without thinking twice, David bought several coins, trusting the slick website and its glowing reviews. But when he tried to resell the coins a few months later, he discovered the awful truth. They were worth far less than he paid. And worse, some weren't even real gold. David isn't alone. Thousands of investors fall for similar scams every year, losing significant sums of money because they don't do enough research. Scammers prey on the rush to buy gold during uncertain times, using fake websites, counterfeit coins, and inflated claims about rare collectibles. Number 1. Stick to reputable dealers. Only buy from well-established dealers who have a long-standing reputation in the industry. Look for certifications like the Professional Numismatists Guild (PNG) or American Numismatic Association (ANA). These dealers follow strict ethical guidelines and ensure authenticity. Number 2. Avoid rare or collectible coins. Unless you're an expert in numismatics, steer clear of so-called rare coins. These often come with huge premiums and are difficult to resell. Focus on gold bullion or widely recognized coins like the American Gold Eagle or Canadian Maple Leaf, which are easier to trade and authenticate. And number 3, always verify authenticity. Ask for documentation that verifies the gold's authenticity, including serial numbers or assay certificates. Any reputable seller will be more than happy to provide these. If they hesitate, walk away. David's story is a warning to all gold investors. Without proper research, you can easily become a target for scammers. The gold market is filled with legitimate dealers, but it's also a playground for criminals looking to take advantage of those who are unaware. When investing in gold, always do your homework. Stick to trusted dealers, avoid collectible coins unless you're an expert, and never rush into a deal that seems too good to be true. Protecting your investment starts with protecting yourself from scams. Let me introduce you to Mark. He invested heavily in physical gold, confident that it was a smart, secure choice. But when Mark needed quick cash for an emergency, he discovered something troubling. Selling his gold wasn't as easy as he thought. He had to shop around to find a buyer willing to offer a fair price, and even then, he was offered much less than the current market price. What Mark didn't realize was that not all forms of gold are equally liquid. This is a mistake many investors make. They assume gold can be easily converted to cash at any time. While gold is a highly liquid asset, the form in which you hold it, coins, bars or ETFs, can dramatically impact how quickly and easily you can sell it and at what price. Physical gold, like bars or coins, isn't always easy to sell quickly, especially if you bought from a dealer who charges high premiums or if you're trying to sell niche collectible coins. In many cases, buyers will offer you less than the spot price because they too need to make a profit. Additionally, the process of selling physical gold can take time, finding a buyer, negotiating and ensuring authenticity. On the other hand, gold ETFs or other gold-backed financial instruments are much more liquid. You can buy and sell these on the stock market with the click of a button, and they trade close to the spot price, offering a much faster way to cash out when needed. First, understand the forms of gold. If you're buying physical gold, be prepared for the possibility that it may take time to sell and that you may not get the exact spot price. If you want quicker liquidity, consider diversifying with gold ETFs or gold funds, which can be easily traded in the stock market. And second, consider your needs. Before you invest, think about your goals. If you're looking for an investment that you can quickly turn into cash, physical gold might not be your best option. If liquidity is a priority, go for ETFs or allocated gold accounts where gold is held for you but easily tradable. Mark's story highlights an important lesson. Just because gold is valuable doesn't mean it's always easy to sell at a moment's notice. When you misunderstand liquidity, you may find yourself in a situation where you can't access cash when you need it most. Understanding this difference could be the key to making smarter gold investments. Gold is a great store of value, but not all gold is created equal when it comes to liquidity. Know the difference between physical gold and gold-backed financial products, and align your choices with your financial needs. Imagine Emily, an experienced investor who decided to cash in on her gold investment after seeing prices rise. She was thrilled with her gains until tax season arrived. Emily was hit with a significant capital gains tax on her profits, something she hadn't factored into her original plan. The worst part? She could have minimized her tax bill if she had structured her investment differently. This is a common mistake. Many gold investors focus solely on buying and selling, but forget about the tax implications. When you sell gold, especially physical gold, any profit you make is subject to capital gains tax. In countries like the US, gold is treated as a collectible, meaning it can be taxed at a higher rate than other investments. In the US, for example, profits from gold sales are taxed as collectibles, meaning they could be subject to up to 28% in capital gains tax. That's much higher than the 15 to 20% typically applied to stocks or bonds. Investors often overlook this, leading to a surprise tax bill that can eat into their returns. Additionally, if you're holding gold through ETFs or other financial instruments, the tax treatment may differ, potentially allowing for more favorable rates. Ignoring these tax rules can lead to a much lower net profit than expected, leaving you with far less than you had originally anticipated. Number 1. Consult a tax professional. Before selling your gold, consult with a tax advisor who understands the specific tax laws in your country. They can help you determine the best time and method to sell your gold to minimize taxes. And number 2, plan your exit strategy. If you're holding gold for investment purposes, have a plan in place for when and how to sell. Spreading out your sales or investing through vehicles like gold ETFs may help you lower your tax liability. Emily's story is a perfect example of how easy it is to focus on profits while overlooking tax obligations. Taxes can significantly reduce your real gains, and failing to plan for them can leave you with far less than you expected. A little foresight can go a long way in protecting your investment. Don't let taxes take a chunk out of your hard-earned gains. Understand the tax rules surrounding gold And make sure your investment strategy accounts for potential tax liabilities to avoid any unpleasant surprises down the road. Let me tell you about Robert. Robert invested in gold during a period of uncertainty, confident that it would protect his wealth. But as the years passed, he realized he had no real plan for when to sell. Should he wait for gold prices to rise higher? Should he sell now and secure his gains? Without a clear exit strategy, Robert was stuck, unsure of how to make the most of his investment. This is a mistake many investors make, buying gold without a plan for when and how to sell it. Gold is a long-term investment, but you need to have a well-thought-out exit strategy in place to maximize your returns and avoid emotional decisions that could hurt your gains. First, set target prices. Determine in advance at what price you'll start selling your gold. Whether that's based on a percentage gain or a specific price point, having this goal helps take emotions out of the decision. Next, diversify your selling. Instead of selling all your gold at once, consider selling it in stages. This allows you to benefit from any continued price growth while still locking in gains over time. And third, consider the market environment. Keep an eye on economic indicators. Gold typically rises during crises and inflationary periods, but may fall when the economy recovers. Plan your exit around these cycles to make sure you're selling when it's most advantageous. Robert's story highlights why an exit strategy is crucial for any gold investor. Without it, you're left making decisions based on gut feelings, which can lead to missed opportunities or poor timing. A clear plan ensures that you make the most of your investment, securing profits when the time is right. And there you have it. The 7 fatal mistakes most investors make with gold, plus one critical bonus tip that could be the key to unlocking the full potential of your gold investment. Whether you're new to gold or have been investing for years, avoiding these mistakes will give you the edge you need to protect and grow your wealth. Remember, gold can be a powerful tool for financial security, but only if you approach it with a clear strategy and avoid the pitfalls we've discussed today. If you found this video helpful, don't forget to like and subscribe for more tips that can help you on your investment journey. And as always, leave your thoughts or questions in the comments. I'm here to help. Peace out.